Welcome. I'm McAlhany, a business advisor with the Maine Small Business Development Centers. We'll say more about that in just a second, but welcome to our webinar today, Financing Application Do's and Don'ts. Next slide. Just confirming the title and the topic we are presenting, starting with the funnel, talking about our program from the broadest point of view. We are the Maine SBDC in the state of Maine, but we're also affiliated with their SBDCs in all states, which some people don't know. So we're part of this larger network which gives us really valuable resources to help us be prepared to work with clients and their businesses. You'll notice some logos at the bottom. The SBA is one that is, as we know, a federal agency. So some money comes into the state from the SBA, the Small Business Administration. Which does tell people I'm not a state or federal employee. You'll see the state of Maine logo as well, and there's some money that comes into our program from the state budget, and then it's matched with other sources from our host. But we're happy to be here and a part of a larger group. Looks like most of you are already on mute. That's helpful, just those few housekeeping details. We've done this for a while, but sometimes we forget, and it's helpful to refresh our minds of that keep yourself on mute. The conversation, the webinar is being recorded. Some people like to look at it later, and I know that some of us sign up for a webinar that we can't attend, but we will be sending the link to the webinar as well as a few forms that we talk about as a follow-up to the email. If you could submit any questions in the chat, that's helpful. I, for one, am not great at watching the chat when I'm talking. I need to focus on keeping that conversation going, but I am here with my colleague Chris, and we'll try to bounce off of it, or we're a relatively small group. We can certainly address any questions. We've set aside time for Q&A at the end of our presentation. Next, I talked about the big picture. Chris, why don't you talk about our program here in Maine?
So what does the Maine Small Business Development Center do? Most importantly, we are providing assistance at no cost and confidentially to current business owners or existing business owners. And that advising can touch on a number of topics. It could be startups, it could be writing a business plan, it could be an exit strategy or looking to sell your business. We also help you look for financing and address credit as it pertains to financing. We can assist with financial analysis and doing your projections. Also, marketing and sales, HR, operations management. We really try to cover on a comprehensive area of topics. And if we don't know the answer, we certainly do our best to point you in the direction of the answer and make sure that we're able to get you the assistance that you need. There are a few things, however, that we are not permitted to touch on. And first, and most importantly, tax, legal, or accounting advice. And that's for the obvious reason that most of us are not lawyers or accountants. So we wouldn't want to be responsible for steering anyone in the wrong direction. The information that we provide you, the materials we give you, it's for information purposes. It's not necessarily for you to go out and publish on your website or bring to another appointment. And although we can't advise on tax and legal issues, we will be a resource for you. We can provide information. We can direct you towards other people that are in a position to help you. But we will encourage you to get in touch with your own team and make sure that you are getting the most solid advice in that area as well. And without any further ado, Ann and I can formally introduce ourselves. My name is Christina Dodge. I am the business advisor for Central Maine. So that primarily consists of Somerset County and Northern Kennebec County. But we draw those lines pretty loosely, and we're available really to help anybody. So both of us have included our phone numbers and our emails on the screen. And at the end of the session, we'll give you some more information on how to contact the SBDC. And now you've met Ann, but I'll let her tell you a little more about herself.
Yep, I'm Ann McAlhany, and I'm in the Bangor office literally right now. And the the Bangor office covers largely Penobscot and Piscataquis County. That being said, the pandemic did help us push us into this virtual world, so often we can work with clients virtually. I also do specialize in food and ag, so I have sometimes work with clients that are in other spots because, as Chris said, we cover a lot of bases in the services that we provide, but we all have our own personal backgrounds before we started this job and training that we've done, professional development. So some of us have more information in one area or the other. And that's the benefit of our state and then national organization. We can link you to others. We'll jump in next to chat for a second about today's agenda. Remember that we are framing this conversation assuming that you are applying for financing somewhere. So the assumption is you're applying for money that you will need to pay back. We're not talking about grants or pitching to investors per se, but really that you're looking for money that you will need to pay back at some time is the frame for this conversation. We'll talk about lender lingo. The lens through which we'll start to look at this is what we call the C's of credit, and we'll get to that in a second. We'll drill down into what those are. Because when we're talking about financing and lenders, we're also talking, the framework is risk mitigation. Lenders are risk averse. So remember, they want to make sure that they're loaning money that gets paid back. And they will frame that in their approval can be based on whether they think you can be successful and pay the money back. There's certain documents and paperwork that you'll need in order to apply to most any lender. And we'll talk about some of those specifics so you can be prepared. And then finally, we'll close with loan application best practices and some do's and don'ts. We want to make sure you're well prepared to be successful. Chris, why don't you get us started with those C's of credit? Because that's helpful. You've got a great background to talk about those.
So the 5 C's of credit is sort of the foundation that a lender is using, and it's kind of the vocabulary that you'll hear conversations revolve around. And they're important pieces of it, and they're small terms with a lot of meaning. So the first one you'll hear is character, and that just doesn't mean do you have a good sense of humor or are you the class clown.
Whoop, Chris, you froze. Your screen froze. So I will if others could chime in, hopefully you can still hear me and that wasn't the whole. Can others hear me? Can you hear me, Jennifer?
Yeah, okay, I can hear you.
I see a nod. So I will pick it up, and when Chris can come back, we'll invite her back in. As she said, the C's of credit character is not just how you work in the community, but also it really reflects on what is your pattern of fiscal responsibility. Oftentimes, do you pay other loans back? Capacity means, well, Jen, we lost that. Oh, there you are, Chris. You're on mute, but your screen froze. You there, Chris? Can you unfreeze your? Are you still muted? You're still muted on our side. We can't hear you. Nope, you're still muted. Maybe you need to log out and come back in.
Let's try. How about now?
Perfect. You're back.
Okay, wonderful. Let's see if we can get, here we go. So character.
We don't have the screen. We don't have the slides.
Goodness.
It dropped those as well.
I am so sorry for these technical difficulties. It seems like every time there's a little something.
Another little surprise, right? So part of that is contingency and plan B in those C's of credit, right? But we'll let you, if you can get the slide back up.
Yeah.
If not, I can bring them up.
Let's see. No, that didn't work.
Well, let me,
Oh, wait.
can you
Here we
see
go.
that? I pulled it up. Can you see that, Chris?
Wait, I think
don't
Yeah, we can see that, Anne. If you just go ahead and share
Yeah.
from
Oh,
your.
There's
right.
okay. Chris.
Perfect.
I think I'm back, and again,
Okay.
I'm so sorry for all of the little technical issues.
All right. We're
So
still
Chris,
seeing
you're
you.
gonna go to slideshow and play from current slide
Yeah,
from that second tab in. There you go.
there we go. All
All
right.
righty.
We are back. So, on the subject of character, we're really talking largely about your, not just your credit, but your credit score is a big piece of that, right? Because they're looking to see what your history is and what your, in a sense, what your values are. Because do you pay your bills? You know, and it's tied a little bit to reputation. If you're applying for a loan from the bank, which you have your business accounts with, they're certainly going to evaluate what type of customer you are. Are you overdrafting your account? Are you responsive to inquiries? All of that will play into what is deemed your character. The next one is probably the biggest and most important one, capacity. Are you going to have enough revenue and cash flow to pay back the money that they loan you? So how do they determine that? And we'll talk a little bit more about that. But basically, if you have an existing business, they're going to largely look at your history and what you've had for revenue and expenses and whether that is has capacity for you to pay back. If you're a startup, you don't have that to rely on. So what's going to happen next? You're going to have financial projections. You're going to have to say, this is the amount of money I anticipate bringing into my business. And these are the expenses associated with the business. And does that leave room to pay back a loan? And it's not just having a number, because in a sense, it's your educated guess. You have to be able to defend that a little bit. And we call that presenting your assumptions. What did you assume to come up with these numbers? You know, oftentimes, you know, if we talked about a coffee shop, how many cups of coffee a day do you have to sell to come up with the money that you need at the end of the month to pay it back? So we spend a lot of time with people making sure that those numbers are easily explained and that the assumptions pass the straight face test. So a lot of time will be spent in preparation on that. Capital. Capital is the amount of money you're putting into your business. So if you're going to get a loan for a building to put your business in, a lender is going to look for 20 to 25% money coming in from you towards that, because the principle is you want them to invest. You have to be willing to invest. Conditions. So these are a lot of varying factors that will be different on every single loan request. Obviously, the economy, and that impacts what the interest rate will be, which impacts what the loan payment will be, which impacts how much money you have to pay the loan back. It also talks about the specifics of your loan request. There are a lot of different variations to these packages. For example, in Maine, we have a lot of seasonal businesses. So there may be situations where a loan is structured so the repayment happens over a number of months of the year, and the other months you hold off on payments. But those things will vary, and they will be constructed with your lender around the type of business that you have and the way that your income comes in. And then collateral. You need to be able to secure the loan. So if a lender's going to lend you $100,000, what do they have for security that they're going to get repaid in the event that the capacity doesn't work? So I think of it, and I explain it to people a lot, it's like buying a car. You buy a car and the bank lends you money for the car, and they hold the title to the car. And they assume that every month you're going to make the payment and repay the loan. But if something happens and there's a hiccup or a problem and you can't do that, they're going to take the car back to help get their money recovered. And it's the same in any other type of transaction. So when you buy a building, a piece of real estate, that is your collateral. If you're buying a business that has equipment, oftentimes the equipment is collateral, and you'll hear the term all business assets. So that is basically a generic lien or a UCC filing that the lender does with the state to secure those items in the event that you don't repay the loan. That's what they have to try to make good on the amount of the outstanding funds. And in some languages, there are actually additional Cs, and I'll let Ann, if you want to touch on those for us.
Thanks, Chris. There's a few more I've heard of, and sometimes they overlap, or maybe they're just called out differently. You'll hear that here, but top three that I think of when I'm working with clients is cash in, cash out, and credit score. Much as Chris talked about capital, so cash in. Just as a reminder, lenders don't want to take all the risk. So you might could say, I got 10,000 in my savings account, but I really want to save it for later because I'm planning a trip. Lenders aren't going to be keen on loaning 100% of a project to you if you have the resources to put some in. And quite frankly, if you don't have some cash to put in, then they're not going to be most of them won't be terribly keen on helping you out because they want you to be a part of this, whatever project is you're asking for money on. So money from you is an important piece. Cash out. That's like Chris said, does the plan make any sense? When we do these cash flow projections that we'll look at briefly in just a second, does the business make money? When you list all your expenses versus your projected income, sometimes that's like, ooh, I forgot the insurance would be that high, or oh my, that lease I've got was a little more than I thought. So now my cash is squeezed. Does the plan make sense? And to know, well, we'll get to that in a minute. And then credit score. What is your borrowing history? And I've had people come and say, well, my credit score is lousy. I had this, that, or the other, bad breakup. It was their fault. But that doesn't matter because I'm going to borrow on the business. Well, to be really clear, lenders, certainly with small businesses, startups, your credit score is what carries the loan. You will be asked to do a personal guarantee. And it's not like you can say, well, my business is brand new. You are your business in a small business, so that your credit score will matter. And just a comment on that is it's helpful to know, Chris will talk about it later, but you want to know going in what that score is. Why don't we jump to the other paperwork that you'll need? As I said, with loan applications, a lot of it's about risk mitigation. And you might think, oh, the bank wants my tax returns for the past 3 years. Okay, I can find them. Or gee, I wasn't really good about doing them. But they'll want to see what your income, what your tax returns looked like for the past 3 years. Business tax returns, well, if you are a startup, no, there won't be any, and that's fine. If you are an existing business applying for a loan, they'll definitely want to see what was the history of the profit and loss in the business for those usually past 3 years as well. And then the lenders will want to see what's your personal financial statement, and we'll give you some details on that, but that's really what do you own and what do you owe. So that's on the personal side, that's on your side. And then looking forward with the business part, you'll need a business plan and then some of those projections Chris talked about that we'll detail some more in a minute. But how does the money flow through the business? Looking at a number of factors. And you might look at this and say, oh, God, that's awful. Lenders want a lot of stuff from me. I'm just going to go find money somewhere else, or I'll get a home equity loan and it'll be a lot less hassle than this. That troubles me for lots of reasons, because what happens is if you don't do your homework, you could be in trouble. And that's really painful when we have people come back and said, I started my business, but I underestimated how much cash I need. So now I've got all these credit cards that I've used because I didn't want to do the homework to go to the bank for a loan. And now I need to get some more money or I can't open my doors because the renovation cost me more than I thought. And now I need to buy inventory for my restaurant to get started. Those things, quite frankly, are painful. the banks don't ask you for all this just because it's busy work, but their concern about risk mitigation helps you do your due diligence. And it's really important that you do these things, even if you didn't need to go to a lender. So this is really not just busy work from a lender's point of view. It truly, I find helpful for you to productively and thoughtfully start your business.
I'd like to jump in, Anne, if it's okay. I just want to make a footnote to something here. We talked about business tax returns. So if you're already in business, you should have tax returns. But what happens if you're buying a business?
Thank you.
And I have seen this way too many times. So one of the first things, if you were looking to buy a business and you came to meet with me for advising or with Anne, one of the things that we would say to you while we're helping you build these financial projections is ask the seller of the business that you're buying to give you his tax returns for the last 3 years. And very often people come back to me and say, he or she wouldn't give me their tax returns, but here's their QuickBooks reports. That can be a big problem and a red flag, and you really want to take note of this, because if the business performs the way that the seller is presenting it, those tax returns should demonstrate and reinforce that point. If they're not sharing the tax returns, it might mean that it is not performing as well as it's being presented to you. But even a bigger concern is, did the business actually file tax returns? So it's important for us, if we're in a situation where we're buying, to be aware of that. And I just kind of I thought this was a good time to mention that.
Thanks, Chris.
The next form that we're going to talk about is the personal financial statement. And this is a pretty generic form. Regardless of who your bank or lender is, the form is going to ask you for all the same information. And this information, as it's called a personal financial statement, this is about you and your household and your family. So if you own other businesses, those will be a footnote on here, but this is really about you personally. So the first section usually on the form is a list of your assets. So you'll put, your home and your vehicles, your bank accounts, your retirement accounts, anything that you own that has value. And they're going to ask you to assign a value to it. So obviously, if it's a bank account, you log in and you see what the balance is. Same thing with your retirement accounts. But things like your home, your car, your personal belongings, the things in your house, you're just going to kind of make an estimate. And we're going to talk about this a little bit later. You're not necessarily going to go get an appraisal of your house. You might have to, but most likely you're just going to put something here. And you want to make sure that you list the total value. You're not listing the amount of value minus your mortgage. You're going to put the whole value, because the mortgage is going to show up in another column. So then next is all of your liabilities. So that's basically all the money you owe. And this is going to be your mortgage payment, your car payments, student loans, credit cards, all of that will be listed in the liabilities. The next section is going to be income, and this is going to be all sources of income. So it's your jobs, any jobs that you have. If you have rental properties that you get income from and you file that on your tax return on a Schedule E, you're going to want to put that here. And basically all the sources of income that can be child support, alimony. It really is, we're trying to get a snapshot of how well your household is able to pay its bills. Because this is a backup for payment on the business loan. And then debt service. Basically what debt service is looking at is, what are your monthly payments? So how much is your car payment, your mortgage payment, each payment? How much are you paying on your credit cards? That's considered your debt service. And obviously this is going to be compared to your income to make sure that that everything is balanced out on the home front. Here, I'm just going to bring up the print is really tiny. And so I would say don't worry too much about focusing in here. This is the US SBA has a generic form on their website. If you want to do this in advance of going to the bank and kind of have an idea and do your homework, it's a great place to just grab a form and walk through it and see what's on there and get a better understanding. When you're done this form, you're going to basically know what your personal net worth is. So when you own a business, you have a balance sheet. And when you complete your business balance sheet, it tells you what the net worth of the business is. And for your family, for your personal side, you do this form and it lets you know what your personal net worth is. It's actually just a great piece of information to know. And then we'll just go down. This gives you just a little more space. So your page 1 is more of a summary. And on this page, you break out. So if you have multiple loans, you have multiple properties, you're going to list that on here. And it's really good to just help you keep track of everything. It's easy to overlook something if you're doing it in a hurry. So I recommend doing it in advance and just having that information in the forefront of your mind and handy to refer to. The next document that we discussed and mentioned earlier is a business plan. And I will be honest, this is something Ann and I, there isn't a day that goes by that we aren't talking business plan with somebody. And if you go to borrow money from a bank, most likely they're going to require a business plan. I guess I would put a little asterisk here and just comment that there are banks right now that are doing loan programs for businesses on a smaller scale, that they're not looking at the business plan. They're going largely on your credit score and they turn around quickly. But that's really a footnote. Not every lender is doing that, and not every loan amount is going to qualify for that. So the business plan is a really important tool. And it takes some time and it takes some commitment. And, you know, we work with people in different ways. Some people think it's, you know, a lot of fun and they'll jump in and they'll write it over the weekend and send it to us on Monday. Other people want to go through it piece by piece. Because it does require some homework. I think there's a good amount when you're thinking about starting or growing a business or buying one. You have so much information in your mind and you're thinking of all of these different things. This is where you have the opportunity to put it down on paper and put it in front of you. And in addition to the things that you already know, we usually provide our clients with a template, and it really walks you through almost in tutorial form that reminds you of the things that you need to be looking at. So, you know, you need to look at where you're located and who your competitors are. And there's a number of things. And I think a misconception, and I don't know if you agree with this, is that a lot of people believe you only want to have a business plan when you start a business. And once you get your loan, you put it in a drawer and forget about it. And I really discourage that because I look at it as an accountability document. So if you've started a business and you made all of these financial projections and you get going and you're running your monthly financial reports and you're looking and you start to think that isn't exactly what I had projected, it's a great time to pull this out and compare what you've really done to what you thought you were going to do and see where those differences are. And then if you identify discrepancies, how do you fix those? How do you mitigate those so that you can be closer to what your plan suggested? So within the business plan, there are multiple sections. So there's one that is really an overview, and it talks about just some of the very generic details about what your product and service is, where you'll be, what your hours are, how you get that product or service to your clientele. The next part is a marketing plan. And there's a great variation on this. Some people need a very basic one, and other people will need to go in depth because maybe their customers are a little harder to reach, or they have a lot of competition, so they really need to be comprehensive in what they're putting out for information. And that's a section that we can help you with. We have access to a lot of data through state and national organizations that we can help you put in and integrate into the plan, to help you have a better understanding and help you communicate that to your lender. The organizational plan is going to talk about you as the owner. And it's a great opportunity to tout yourself and talk about your background, why you're doing this. I think you can be as detailed as you want. Tell a story. Talk about your background, your interest, your passion. And then talk about who's going to be working with you, how they're going to get paid. And then also here, we're going to want you to look at what's your legal entity. Are you forming an LLC? Do you need a bunch of licenses? Do you need permits? And a lot of this depends on your industry and where you're located. And then the financial plan. And I think this is where we spend a lot of time with people. And this is where lenders are really focused. And this is going to talk about the sources and uses of funding. And I always call that the lender's Bible. I was a lender before I was with the SBDC. I was a commercial lender, and that would be the first page I would look at. So the sources and uses are what they sound like. Where is all the money coming from? So you're going to break it out line by line. How much money are you putting in? How much money are you looking to borrow? And then other sources. Do you have investors? Are you getting grants? Any place that you're getting money that's going into this business will be listed there. And then the uses of funding. And oftentimes people need to start with the uses to then back into what the sources are going to be. But the uses will break down exactly what it's going to cost you to acquire or build this business. So it could be the purchase of real estate. It could be a deposit on a lease. It's going to be the equipment that you need and your furniture and fixture. And then working capital. You've got to start with some money in the bank to pay your staff, to pay your monthly bills. So that all needs to be figured in there. And we'll spend a lot of time because we know how closely the lender is going to look at that. And I will bring up kind of a basic financial projection. And I think Anne could talk about this and how to do it and how it will help you.
Certainly. Thanks, Chris. And just a quick PSA for public service announcement is that I am already on the schedule for doing a workshop on writing a business plan, which is next Tuesday, I think on the 2nd at noontime as well. And we'll go into more details about those things Chris highlighted for us. I will also acknowledge that we're already past our 12:30 mark. And I'd like to be aware of what we've promised that we'd be done in 30 minutes. And obviously we're not today. So I will go through this fairly quickly, and I'm happy in the Q&A or individually if people want to reach out, follow up on any of these components. But quickly, this is just an example of a cash flow projection. And I know that people find this often overwhelming. They are maybe okay with writing or not the narrative, but putting it into numbers on a piece of paper, there's a lot of stuff there, it seems. And I just encourage people and work with people to do it one box at a time. To me, it's like solving a puzzle. Often we start with what we call the fixed expenses, things that don't change, like rent or insurance or phone bill. And then we work back into how we put together the income part, the sales part, and break it into pieces that become more manageable. And as Chris referred to, I tell folks, the cash flow projections are only as good as the assumptions that back it up. So if you've got something like an insurance number in there, how'd you come up with that number? Maybe it's a quote, maybe it's an estimate for my cousin or neighbor. Anyway, so coming up with assumptions that back up how we came up with the numbers. And now we've got one that's much smaller because there's just more things on it, but it's put together the same way. At the top, money comes in. Some businesses have what we call a cost of goods. something that's a cost of materials, for instance, to generate those sales, like a restaurant has food, or a woodworking shop might have wood to make furniture. And then we have fixed expenses, and at the bottom we can reflect debt service or loan payments, that is, and look at what is the seasonality of a business, because January sales might be very different than July. Then Chris can also talk to us next about, as we come more to a close, and again, we'll cover more in the Q&A if you wish, but what are some of the things to think about? What are some of those best practices when you pull all these pieces together and get ready to hand it over or click that submit button to the lender?
So I think anybody, by the time you've gone through writing your business plan and all of the steps to do this, you want to submit your application and get an answer as quickly as possible. And the best way to have that happen is to be really well prepared going into that process. So, make sure you've read the application, written down questions, and asked them to your lender. There can be a lot of information on there, and you don't want to accidentally, inadvertently put the wrong answer that could impact the outcome. So read through that application and have your questions answered. Then have all your tax returns ready to submit. And it's important. This isn't just the first 2 pages of your 1040. This is all of the attachments that go with it, all of those schedules, because those are referred to pretty thoroughly. Next, little ad for the SBDC, but work with a business advisor. We are pretty seasoned at doing this, and we work with and talk with lenders all the time, and we know what they're looking for, and we know how to assemble it in a way that is sequential, and it makes a lot of sense. And so rather than having to go back and redo it, we'll help you anticipate what questions might come up and hopefully answer those in advance. And I don't think this next point, I don't think we can say this enough, but make sure that those financial projections include assumptions. Because if it looks like you need to sell 10,000 cups of coffee every weekend at your Waterville, Maine coffee shop, the lender's going to scratch their head. So make sure that you have data and good explanations of why that you're putting what you are in those projections. And last, and this is sort of an old pet peeve of mine from when I was a lender, but many people on their PFS, when they're listing their assets, will say, my house is worth $1 million. My car is worth $55,000. And while we may not be asking you may not be asked to demonstrate that, there is going to be a little bit of a litmus test done on those. So pretty much every community now, somebody publicly can log on to your address and see what the assessed value of your house is. Understanding that is not necessarily equivalent to the market value, but it's going to indicate if there's a really big discrepancy here, and that is going to reflect back on your character that we talked about earlier. So these are things for a startup, but what if you're an existing businesses? All of the things that we just mentioned are still going to matter, but you're also going to need your historical tax returns. If you're more than a couple of months into the calendar year like we are now, year-to-date numbers will probably be requested. And then one thing that your lender is going to be looking at is trends. Have your revenues been increasing, but your profits been decreasing? So why? Look at those trends and understand why. And if you're losing money, it doesn't mean you shouldn't apply for a loan, but you need to understand why you've lost money and explain how these loan funds will help turn this around and improve your trends. So again, it's about being well-versed and understanding your numbers. And a lot of it is how you can talk to your lender, and Anne will explain what we refer to as the elevator pitch.
Thanks, Chris. It's really, how can you summarize or highlight the goals and the why of your business? What what product or service are you offering? Where are you doing it? And then how do you make money is some of the things we note, but really it's answering those questions. What's the problem out there in the marketplace that I'm solving, and why am I the correct person to do it, and how will I make money doing it? But to highlight those, again, in a nutshell, in maybe 4 sentences, because sometimes we have short attention spans, and how do I summarize those highlights? And it forces us to focus on the core parts of our business, to come up with this elevator pitch of just a few sentences, and to be clear that you understand everything you put together. Our job's not to write it for you, but to help guide you through that process. You need to understand it to be able to communicate it to a lender or to others. And then finally, we've got just 2 more slides, I think, of content. A couple of do's and don'ts, just to highlight the things we've talked about. Make sure you research, not all funding's created equal. I would say be cautious of credit cards that might have a 0% interest rate now, but know that they go to 22%. Probably ready before you're ready for them to do so. You can shop around for funding. Be cautious of too many hits on your credit score. Sometimes there are choices, so interview potential lenders, because one person might, or bank or institution might be a better fit for you than another, and it's fine to talk with a couple people. As Chris said, be organized. That's your first impression to any lender, is having all your paperwork together. Provide that documentation. If they say, I need a copy of the front and the back of your driver's license, and you send them only a copy of the front, do you think they're going to think that you got your act together? No, it's just going to put you to the bottom of the key when you're chomping at the bit and wondering why they haven't answered you. Be honest, it will catch up with you if you don't, and definitely know your credit score. If there's problems with your credit, or I had a hiccup with paying that phone bill in the past, or I had a medical bill, know it, because they're going to find out, and it's much better for you if you can explain it and address it in advance. And then sometimes there's workarounds, so it's not always the end of the world, but at least understand what's on that credit report. What about a couple of things we should avoid there, Chris?
So don't sign any contracts without careful review. I think because of the way the real estate market is, people are really quick to go out and want to sign a lease or a purchase and sale agreement. But you really need to do your due diligence before you sign on that line, especially, if it's a legal document. Another thing that's important is don't withhold any information that could impact their receipt of funds. So if you know that your spouse is about to be laid off and that's going to impact your family income, be upfront about that. I think when you're honest, lenders are going to work with you. If they have to find out things on their own that you withheld, again, that's a ding against that character piece of it. Don't accept terms that you're not comfortable with. Don't be in such a hurry that you'll take whatever money comes your way, because you don't want to have to go back and renegotiate or look for something else. Make sure that you find the arrangement that's going to work best for you. And don't assume and don't duck. So no assumptions. Just make sure that you are doing your homework. That is some of what Ann and I and the rest of the SBDC team is here to help you with. We have clients all the time coming in with what they've been told and what they have, and we help them figure out how to work through that. And so we are way over our time now, and I'd like to just apologize again for the technical difficulties, and thank you for your patience. Our next slide here is contact information for Ann and I, as well as our state website. And this QR code will just, if you scan it with your phone, will bring you right to that website. And at this point, that concludes the presentation that we had for you today. But we would be happy to have people jump in with any questions.
And as Chris said, you're free to reach out to us. Some of you might or might not already be into our system, signed in as connected with an advisor. You're welcome to reach out to us if you have further questions. There's a brief intake form that gets you into our system officially, and we're happy to answer any follow-up questions that are helpful to you. And certainly, what questions are there right now? Just as a reminder, all that business credit and personal credit do overlap. Do overlap in a small business. There's very few times you can, only when you have larger corporate businesses, maybe, you know, you're not doing personal guarantees, but that's not the world that we work in. And as Chris commented, with a business loan, if you've got a loan and then something maybe goes south, something you didn't anticipate, then be sure to reach out to your lender. It's better to communicate those problems earlier rather than later. As we said, don't duck, don't put your head in the sand. Be sure to reach out and talk with your lender. And yes, on our webpage is the link, and I think Jennifer just put it into the chat for the business planning workshop next week.
Well, if that is it for questions, again, if you think of something later, feel free to reach out to us. We're happy to talk with you. And we will wrap up for today, and you will be getting a copy of this presentation in your email shortly. And thank you so much for attending. We appreciate you being here, and hope that you are leaving with the information that you hope to get.
At least we planted some seeds, and we're, again, as Christina said, we're happy to follow up and wish you best in your business ventures.